Hi class, this is the second lecture and last lecture that I'm going to give you on chapter 4, and this lecture is going to be on stock redemptions and also the attribution rules under section 318, and you'll see the interplay of stock redemptions and why it's important to understand the stock ownership attribution rules under 318. And then finally, I will, after I finish talking through some of these concepts, I'll quickly walk you through problem 43, which is an attribution problem, which you've also been assigned. So first of all, what is a stock redemption? Well, a stock redemption is where a corporation acquires its own stock. So it takes back its own stock in exchange for corporate property. So it gives a shareholder some of its property, and that could be cash or other types of property, in exchange for its stock, which the shareholder currently has. And the corporation could either cancel the acquired stock, it could retire it, or it could just hold it as treasury stock. There are several reasons laid out in the text why a redemption may be desirable for a corporation. It may be because the shareholder wants to withdraw from the corporate business and get rid of his equity in the corporation. It could be that the shareholder is required under some sort of an agreement, a stock purchase agreement, to sell its stock at some period of time back to the corporation. It could be that the shareholder simply wants to reduce his equity in the corporation but doesn't want to sell the stock back to outsiders. So he'd rather sell the stock back to the corporation than to sell it to outsiders, and that may happen in a closely held corporation situation. And then there are a few other situations where a stock redemption may be desirable. So there are questions, and here's an example in the PowerPoint slides where Y Corporation is distributing $100 to corporate shareholder A in exchange for 10 shares of Y's stock held by A. And in this situation, the fair market value of the distribution is $100, and the fair market value of the stock, rather, is deemed to be $100 because that's the fair market value of the cash that was distributed. And then in order to figure out the realized gain or loss by shareholder A upon redemption, you would need to know its adjusted basis in the stock in Y, and in this case it's $20. So in the stock redemption of A's equity in corporation Y, it realizes a gain of $80, and we'll then have to figure out how much of that gain is is recognized, if any. And then in the other situation, we've got land, so non-cash property. Land is being distributed out to B, corporate shareholder B, in exchange for 10 shares of Y's stock held by B. So here's another type of stock redemption. And in this case, the land has a fair market value of $100 and an adjusted basis to the corporation of $40. And the shares in Y have a fair market value of $100 and basis of $30 to B. So then we have to determine what we're going to do with this, how we're going to treat this stock redemption, both for Y's purposes as well as A's and B's purposes. So the issues for A and B, the shareholders, are the following. What is the amount of the distribution? And, with cash, that we know the amount is easy to determine, but with land or other types of non-cash property, it's a little bit more difficult. Is the distribution going to be a dividend? And we talked about that a while back, where we were talking about how you determine the the consequences of a distribution, and E&P becomes important in that regard. What is the gain or loss realized upon redemption to the shareholder, and what is the recognized gain or loss, if any, of that realized gain or loss? What's the character of the gain? What's the shareholder's basis in the distributed property? So does he take on the same basis as what the corporation has, or is he going to take on a basis equal to fair market value or something else? What's the holding period going to be in the distributed property, and what basis does the shareholder have in the remaining stock? So he may not be redeeming all of his stock, he may just be redeeming some of it. And then we have the question, what do we do with the remaining stock? What type of a basis does the shareholder take in that remaining stock? And then we have to know what the consequences of the redemption are. So then we get answers then to these issues. Redemptions can be treated as either a stock sale or a dividend, depending upon the circumstances. And also, a distribution is usually considered a dividend if the shareholder's proportionate interest has not changed or increases. So in other words, if there's not a disproportionate change in the shareholder's interest in the corporation, in its equity interest in the corporation, then the distribution is usually considered to be a dividend rather than a stock sale. But if the shareholder's interest has been substantially reduced, the redemption is going to be considered a sale. And that kind of makes sense, right? Because if the shareholder still owns pretty much the same equity interest that it did after the redemption as it did before the redemption, then it should be treated as a shareholder with regard to that redemption, and you would normally treat a distribution to the extent of E&P in the corporation as a dividend. But if the shareholder is essentially losing all of its equity interest upon redemption, and now it's considered to be sort of an outsider, if you will, a non-shareholder, then in that case you would normally treat giving up of some property like stock as a sale. So that's why they look at the disproportionate interest rule in determining whether the redemption is going to be treated as a dividend or as a sale. You also have to consider the attribution rules in determining whether the shareholder's proportionate interest has changed. And that's because you not only look to the shareholder's interest in the corporation, but you look at the ownership of the corporation in by entities who are somehow related to the shareholder that is the subject of the actual redemption. And to do that, we look at the rules under Section 318, where stock ownership is determined under a constructive ownership idea or concept. So under 318, a shareholder obviously owns his own shares and he has a direct interest in those shares, plus he's deemed to own the shares owned by different family members, his spouse, his immediate family members, and other related entities. And those are called the family attribution rules, which you can read more about in the chapter. And then a corporate shareholder is considered to constructively own shares owned by its shareholders, partners, and beneficiaries. And those are the corporation attribution rules. So here's an example here. We have Frank owning 25 shares. We've got Harry owning 25 shares, and Wilma owning 25 shares, and Steve owning 25 shares. But if some of those people, Frank and Harry and Wilma and Steve, are somehow related, these arrows are showing that they, like Harry and Wilma, might be spouses. So if they're spouses, then Wilma's 25 shares are deemed to be owned by Harry, and Harry's 25 shares are deemed to be held by Wilma. Also, Steve, who's the son of Wilma and Harry, is deemed to own the shares of his parents, and his parents are deemed to own the shares of their son, Steve. And the same with Frank, who's the father of Harry. There's an attribution that goes back and forth between father and son. And then so there are several rules that you look at in order to determine whether the redemption is going to be considered a stock sale instead of a dividend under redemption. And they are the following. If, as we discussed, the redemption is considered to be substantially disproportionate, so that the ownership is going to be substantially disproportionate after the redemption as compared to before the redemption, then that's going to be considered to be a stock sale instead of a dividend. If the redemption is in complete termination of a shareholder's interest, it's going to be a stock sale. If the stock sale is not essentially equivalent to a dividend, then it's going to be considered a stock sale. If it involves a partial liquidation of the corporation with redeeming stock from a non-corporate shareholder, then it's going to be considered a stock sale. And finally, if this redemption is providing funds for an estate to pay its death taxes, that is going to be considered to be a stock sale instead of a dividend. Then we look at the impact to the shareholder if the redemption is considered a stock sale. First of all, the amount of the redemption is going to be equal to the fair market value of the distribution. And then we calculate our gain or loss realized as the fair market value of the distributed property minus the tax adjusted basis of the stock that we redeem, that we give up to the corporation. Our gain or loss recognized is the same as our realized gain or loss. So we recognize both a gain or a loss upon redemption if it's considered to be a stock sale. The character is capital because the nature of the stock that's being redeemed is a capital asset to the shareholder, the redeeming shareholder. So it's actually considered to be a capital gain or loss. The basis that the shareholder will take in the property distributed to him in exchange for his stock will be fair market value. The holding period is going to start the day after distribution, so no carryover in holding period. And then the basis in the remaining stock is going to be proportional. So if he doesn't give up all of his stock, then he basically looks at what he didn't give up. And let's say he had a total basis in his stock of $30 and he gives up half of the stock in redemption. His new basis in the stock that he keeps will be $15 because he gave up 50% of the stock. So the other 50% is multiplied by the total basis of 30 to come up with $15. Here's a definition of substantially disproportionate redemptions. Where you have a substantially disproportionate redemption, it's deemed to be a sale with capital gain treatment. And it will be considered to be substantially disproportionate if all three of the following requirements are met. First of all, the shareholder owns less than 50% of the total combined voting power of all classes of voting stock after the redemption. Secondly, they own less than 80% of the voting stock prior to redemption, and they own less than 80% of the ownership of common stock prior to redemption. So both the voting and common stock, they have to have owned less than 80% prior to redemption, and then after redemption, they have to own less than 50% of all classes of voting stock. And in the case of a substantially disproportionate redemption, you do apply the 318 attribution rules, and that's important because we're looking at ownership of the company before and after redemption. So you want to make sure that you're looking at not just the shareholder's ownership of the company before and after redemption, but also of his related entities under the 318 attribution rules before and after distribution, or before and after redemption. And then if you have a complete termination of the shareholder's interest, the complete termination is going to be treated as a sale or exchange. And a complete termination is defined as a substantially, it is also defined as a substantially disproportionate redemption. Now, what is a redemption that's not essentially equivalent to a dividend, which was one of our ways back here, where we're going to, one of our conditions where we're going to have a redemption be considered a stock sale is where it is not essentially equivalent to a dividend. And you might wonder what that is. Well, here's where it's defined right here. So Section 302B1 says that they consider the following a sale or exchange: a redemption of non-voting preferred stock where the shareholder doesn't own any common stock, or a situation where a shareholder has a substantial reduction in the right to vote, exercise control, participate in earnings, and share in net assets upon liquidation. These would all be factual questions that you would ask yourself and the corporation and the shareholder upon redemption when you're trying to figure out whether the redemption is not essentially equivalent to a dividend. It is considered a dividend if a shareholder maintains control both before and after the redemption, or if he assumes controlling position after the redemption. And then what is a partial liquidation? That was another situation where your redemption is going to be considered to be a stock sale, is if it's a partial liquidation. And here's the definition of that. Now your impact, we've learned about the impact to the shareholder of a stock sale. We already know the impact if it's going to be treated as a dividend. The impact if it's treated as a dividend takes you back to the rules that we discussed in my last lecture, where we look at to see what the current and accumulated EMP was, and to the extent of current and accumulated EMP, that dividend is going to be treated it's going to be treated as a dividend, and then to the extent there isn't any EMP, then it's going to be treated as a return of capital, and then to the extent that there's no return of no basis left, then it's going to be treated as capital gain. So now we have to look at the impact to the corporation upon redemption. So the corporation realizes a gain or loss, both gain or loss, equal to the amount that it's receiving minus the basis given up of the property that it's distributing. And then it recognizes gain, but it doesn't recognize loss. The character of the gain recognized depends upon the nature of the asset being distributed in redemption. So remember, the corporation transfers property to the shareholder in exchange for the shareholder's stock in the corporation. So the character of the gain recognized would depend upon the nature of the asset being transferred out to the shareholder. And then the impact on EMP, if it's considered a stock redemption, then the recognized gain increases EMP. And then the fair market value of cash or other property decreases EMP. And then the treatment is similar if the property had been sold. You know, it's what they're saying here is the treatment is similar as if the property had been sold. Because we talked about the impact on EMP of sales of property back when we were going through our lecture on EMP. And then if it's considered a dividend, then the EMP is reduced by cash or the principal amount of obligation and greater of the adjusted basis or the fair market value of the property. So these are just factual. You just need to know the rules. Remember the rules when you're trying to decide how you're going to impact your EMP on this redemption. If the stock redemption is considered a sale, then you're going to reduce your EMP by a portion of your current and accumulated EMP attributed attributable to the redeemed stock. So for example, a percentage of the total outstanding shares redeemed not to exceed the actual distribution amount. And then any excess distribution amount reduces the corporation paid in capital. And your effect on current E&P, you deduct dividends before stock redemption amounts. So when you're ordering your effect on E&P, you would deduct your dividends that you made during the year first before your stock redemption amounts. And that's important because it could have a different effect. If you didn't deduct your dividends first, you could end up with capital gain treatment or return of capital treatment on a dividend, on a distribution that would otherwise be treated as a dividend, if you weren't taking this rule into consideration. And then your accumulated E&P, you reduce by chronological order. Same rule as we talked about before. So that's it on the lecture on stock redemptions. And then I want to just show you, in taking you through this problem, get the problem up. So we have a problem here where we're asked to calculate the amount of shares, the number of shares that Laura is deemed to own in Moose Corporation rather, under using the Section 318 attribution rules. And the facts given are that Laura owns 60 shares in Moose Corporation, LMN Partnership owns 50 shares, and Laura is a 20% partner in LMN. LST Partnership owns 100 shares, and Laura is a 70% partner in LST in turn. Lemon Corporation owns 100 shares of Moose, and Laura is a 30% shareholder of Lemon. And Lime Corporation owns 90 shares in Moose, and Laura is a 60% shareholder in Lime. So in total, the shares outstanding of Moose Corporation are 400, and those are the facts that we're given. So what I did for you guys is I drew a pictorial of the ownership. And the way that you draw ownership charts is that a square or a rectangle is always considered to be a corporate entity. A triangle, a right side triangle like this with the one leg up, facing up, is actually considered to be a partnership. And then a circle is considered to be an individual. So in our facts, Moose Corporation is owned 100% by a combination of Laura, LST, LMN, Lime, and Lemon. And in turn, Laura owns a certain percentage of LST and LMN partnerships, and also a certain percentage of Lime and Lemon corporations. So you'll see that in total, the 25%, 22.5%, 12.5%, and 25% total, and 15% by Laura, those five percentages total 100%. So those are the 100% shareholders of Moose, are Lemon, Lime, Laura, LMN, and LST. And then Laura owns 70% of LST. We don't know in our facts who owns the other 30%. It could be some other companies, but we have to assume it's none of these guys. Because if it were, we'd have to apply the 318 attribution rules. And that, that's not in our facts. So we have to assume it's some other third party or third parties that own the other 30% of LST partnership. And then by the same token, Laura only is a 20% partner in LMN. There must be one or more partners who own the other 80% in the LMN partnership, and so forth. Same with Lemon and Lime. Now, what you do normally is, if you're trying to figure out how much indirectly is owned by Laura, you would simply multiply down. So in the case of LMN Partnership owns 12.5% of Moose, and Laura owns 20% of LMN. So indirectly, Laura owns another 20 times 12.5%, or 2.5% of Moose through its ownership of LMN. And we do the same thing with regard to Laura's direct ownership in the LST partnership, and then through LST's ownership in Moose to determine how many shares she's indirectly deemed to own in Moose through her ownership in LST. And then we do the same thing with regard to her ownership in Lime. Now, with regard to Lemon, her ownership in Lemon, she doesn't indirectly own any portion of the shares owned by Lemon in Moose. And the reason why is because 318 says that in order to apply the attribution rules to corporate ownership, the individual needs to own at least 50% of the corporation that owns shares in the entity below it. So because Laura only owns 30% of Lemon, she's not deemed to own any shares of Moose through Lemon's ownership in Moose. So then if we go to the next slide here that I made up for you guys, what I did was I multiplied the total shares outstanding by Moose, and I multiplied that times the 60% ownership in Lime that Laura owns, multiplied times Lime's ownership in Moose. And I come up with an additional 54 shares that are indirectly owned by Laura through Lime's ownership of Moose. Then I do the same thing with regard to LMN's partnership ownership in Moose, and what Laura's indirect ownership is of those shares that are owned by LMN, and then I do the same thing with regard to LST. And I come up with another 10 shares that are owned by Laura indirectly through LMN partnerships, ownership of 12.5% of Moose, and then I come up with another 70 shares that Laura owns indirectly through LST's partnerships ownership of shares in Moose. And then Laura owns 60 of her own shares directly in Moose, which is pictorially shown here with a line drawn directly from Laura down to Moose. You always show ownership as coming up from above. So, I guess just think of it like parent is above, and then the children are below, or the subsidiaries are below, or the partnership is below and the partners are above. Ownership always comes from above. So the owners are shown above the ownees, or the controlled corporation or the controlled partnership or whatever. So parent above, children below. Laura directly owned 60 shares. If I add up the total number of shares that Laura is deemed to own directly and indirectly in Moose, it's 194. And then if I divide that, the problem doesn't ask us to do this, but if I divide that by the total shares outstanding in Moose of 400, she is deemed to own 48.5% of the shares of Moose, directly and indirectly. If I go back to my problem, indeed, that's what it shows here is, first they do a breakdown of the total shares owned by each of the entities, and then they work it through. But they don't show you in a pictorial, and I kind of like the pictorial so that you can see how they're coming up with that. They're actually multiplying out that direct and indirect ownership. And again, she's not deemed to own any shares indirectly through Lemon's ownership in Moose because she owns less than 50% of Lemon. Hope that helps you guys talk